Greetings. My name is Sunil Sharma. I'm the Chief Investment Strategist at Ambit GPC, here with your monthly update for August 2026. Let's get started. So we're going to start with the AI narrative. The narrative to date was that the US hyperscalers would come up with these large LLMs, and they were putting in hundreds of billions of dollars and would lead the AI wave. That is clearly not how things have panned out. Kimi K3 is the latest LLM that is being released out of China, and it's clearly looking like open source models and even free models are providing very competitive alternatives to the hyperscaler large LLMs. And so this entire field and the evolution of how this field is going to play out is up in the air, but certainly the narrative that the US would dominate, the hyperscalers would lead this is being questioned. And there's a lot of, so this chart here shows the volatility and the sell-off that is underway, which isn't evident in the US indices, but everything that was what we call AI winners are being impacted, and volatility is through the roof. It's higher volatility than prior episodes around COVID, and even higher in some cases, in many ways, to the Nasdaq bubble crash that we witnessed many years back. So the key takeaway is that the whole narrative around AI has flipped. The other point I'll make in terms of U.S. markets is that the rising interest rates are also starting to impact equities. And so if you look at the last couple of instances where rates started to move higher, there's the 10-year moving above the 4.3, 4.4% level is when markets started to have resistance and started to stagnate. And that's kind of and struggle, and that's kind of what we're seeing today as well, as rates have been inching higher for the US as well as many other highly indebted global markets. The next thing I want to talk about is the cost differential, and we're talking about cost differentials largely between developed markets, let's say Europe and US, and on the emerging market side, China and India in particular. There's a very large differential, and this was actually referred to by the Volkswagen CEO as he announced his 50 to 100,000 layoffs. Cost was a primary reason. And this has repercussions for investors in terms of how you position your portfolios. Now, the INR weakness that we've witnessed makes Indian exports even more attractive. And the other trend that we're witnessing is that increasingly trade is happening between trustworthy partners. Reliability is becoming far more, and trustworthiness becoming far more important than cost. And so that's increasingly what we're calling strategic trade. Now, one of the representations of what I'm talking about is this chart here, which shows China exports to Germany have grown significantly post COVID and post 2022. Meanwhile, German exports, largely cars and other components and machinery, so forth, have started to drop, and clearly competitive issues are coming to the fore. Now, alongside that cost differential, we are witnessing, and we've done a lot of work, it's in the commentary across many industries, what I'm calling emerging or new India or emerging industries within India. And increasingly, we're seeing Indian companies competing on competency rather than cost. And cost is certainly a factor, but increasingly our companies are being able to tie up with global manufacturers and gain entry into some very high competency industries. Listed a bunch of industries that our companies are now gaining inroads into. And so, what we're witnessing is that exports, particularly manufacturing, but also the GCCs and services, both sides were witnessing strong momentum on exports. The other thing is the FDIs. So FDI outflows have also accelerated, and particularly in last 2 months, we've had a $15 billion inflow in the most recent month, which now positions us to be uh, in place to get to 100 billion FDI, gross FDI inflows for the fiscal year, which would then make us one of the top 5 FDI destinations. So FDI is doing pretty well despite what one would hear. And I'm talking about gross FDI's inflows into the country as well as outflows, which I just talked about. And the other metric, and there's a bunch of others that I've covered in the commentary, but corporate formation is accelerating. That's another very strong indication of the strength we're witnessing in the MSME market in particular. But just a large amount of innovation, many important announcements, green hydrogen, powertrain, um, and a bunch of other things that I've listed in the piece that we have made inroads into semiconductors, defense, nuclear, et cetera, et cetera. And so, increasingly we're finding a whole range of companies, and I've listed companies in the commentary as well that are participating in this kind of new industries that are making a strong inroads into high competency, high skill industries. So, like I was talking, this is about the currency exchange rates. These are the broad, nominal, and real broad basket of currencies against which the Indian currency is measured, and clearly shows the Indian currency depreciated across the board, making Indian exports far more attractive. And so this becomes a very interesting time to be looking at companies that are participating in global exports. And so the aerospace, defense, space, auto components, and the engineering, electronics, just some of the industries in which we're seeing many companies make significant inroads. And the other point I'll make is that post episodes of the kind of depreciation we witnessed over the past few months on the INR, that is typically followed by periods of fairly strong equity performance. And there's a chart in the commentary that I've shared in relation to that. So to wrap up our brief summary, what we can call this a clash of macro versus micro. On the micro side, we're glad to report that earnings are looking good. One third of Nifty companies up 18.6% on operating earnings. Mid caps and small caps up significantly higher than that, 35%, 36% year on year earnings, with about 22 to 29% companies reporting respectively on small caps and mid caps. We'll see how those numbers progress, but with one fifth to one third of companies reported, the numbers have been excellent. So we've got that working for us. The AI narrative, which was pulling flows, is no longer pulling flows, and we can see that in the FI flows, which have moderated, and markets have had been doing well until news around the Iran war came in last week, but that also seems to be working through. We prefer after many periods. So we've been negative in terms of the majors, the IT majors, prospects for a long number of years, about 5 years now. And at this point, this is something we noted last month as well. IT is looking far more interesting, and we've started to see a recovery underway, and momentum on sales, momentum on new client wins, and also new hirings and a commitment towards taking advantage of the opportunity on AI. So with strong earnings, the narrative, shifting in terms of where India is in relation to the global environment, the AI trade, and flows continue to be solid. So this is a chart of the new account openings. We just hit a 4-month high this last month, and so clearly momentum remains strong in terms of particularly the young investors that are coming on board and putting money into the markets. And typically they've been focusing on small and mid caps. In terms of our preference, we are now increasingly gap agnostic and really looking at companies that are participating, delivering strong, visible earnings, strong growth, and are well positioned from a fundamental perspective. So, lots more in the piece. Please take a look, and look forward to seeing you again next month. Thanks for watching. Have a great evening. Bye bye.